Good morning. It's a pleasure to be here. Actually, again, I was invited last year on a similar event by Property EU, and I was asked to give a perspective of someone who has been involved in managing the workout process of a loan portfolio for a considerable time, and I gave a sort of an overview of that portfolio, the key learnings, etc. I see maybe one or two faces that were here last year. You're going to be hearing sort of a similar perspective, naturally, but an updated one. And if I'm invited again next year, you might hear how things have developed and how things might be coming to a conclusive end. But as a starting point, just a few words on myself and on Reviva Capital. We are a specialized asset manager. We do workout management and restructuring advisory only. That's what we do. We were incorporated out of a spin-out after a successful banking restructuring. And I must comment on the fitting selection of speakers, having an Icelander and a Cypriot talk about distressed assets and bank restructuring is very fitting. Next year you should consider an Irishman and a Spaniard, and you'll have a full house. So I've sort of been in the lion's den for this cycle, first within a bank, and then after a restructuring of that entity in a spin-out asset manager, a standalone asset manager. We have been mandated to manage portfolios with a sort of nominal outstanding of €1.5 billion. Most of it, or almost all of it, is real estate-related loans to start with. A big portion of it actually junior or mezzanine-type debt, which leads us very quickly into the sort of equity space after the price shift that occurred. But some of it is certainly senior debt. The assets are spread in 12 European jurisdictions, but principally in Germany, UK, and the Nordic countries. And what we do essentially is the full front-to-back office servicing. So basically the workout and restructuring, but also the operations of the loan portfolios and the assets. And we're a regulated entity, and as I said before, based in Luxembourg. Now the sort of case study at hand is a loan book. It's a real case. The numbers are more or less up to date and accurate. The nominal value originally was €1 billion. The number of loans or connections, 185. The senior-junior ranking was sort of 40% senior loans and 60% junior loans. The collateral pool is almost exclusively real estate, but a very mixed bag, 45% residential, multifamily housing primarily, in Germany, Norway, and Sweden, and 20% pure commercial, and a 35% very mixed bag of assets. Substantial volume of square meters and a number of units, as you can see. The number of what I call major restructuring cases is in the region of 40. A loan extension is not a major restructuring case, but a multi-month restructuring workout involving cross-border situations, several other co-lenders, etc., is what we categorize as a major restructuring case. We've had to deal with 11 bankruptcies in the borrower group, many of them cross-border, where the borrower collapsed in one country, but the assets were held in another country, or a whole group of borrowers collapsed in more than 2 jurisdictions. And very importantly, the €1.5 billion, or the 1 billion in this particular case, is the net asset that we are managing. There is over €1 billion of senior debt involved as well, mainly senior. In terms of jurisdiction, you might not be able to read the small print, but that's not really the important thing. It's just to highlight the diversification of the loan, of the assets. The borrower is primarily Scandinavian, but the assets widespread. Big part in Oslo, Norway, fortunately, a very strong market. Considerable part here in the UK, mainly retail assets. Germany, multifamily, and Sweden, multifamily and retail assets, and Finland, shopping centers, and more. So naturally, not a coherent or a homogeneous portfolio, as these are multiple borrowers, and the original lending operation was quite opportunistic and sort of chased borrowers into various jurisdictions and cross-border activities. The The situation in 2008 can be described as quite chaotic, you could say, and distressful. The lender had a parent company that had collapsed, an Icelandic parent company. On the portfolio, several of the co-lenders had collapsed, many of them Danish banks. In the portfolio, several of the borrowers had collapsed because of over-leveraged and illiquidity. And they not only collapsed in terms of their capital structuring, but also in terms of their operations. So we went to market with this book in 2008 and in 2009. The bids were obviously very opportunistic, and the owner decided not to go for an asset deal at the time, but rather a workout process. So the workout management process that we were mandated to drive can be categorized into or grouped into four different steps. And this is no science for those involved in similar activities, and certainly not an invention of ours. But generally, we approach this rather rigidly, I would say, and from a sort of structured standpoint of driving assessment. And you could say the first steps of managing the workout process of such a portfolio is like being in an emergency room in a war zone. You need to prioritize where are the real casualties, where are the real values and lives you can save, and who's really just gone, and there's nothing you can do, and you shouldn't really waste your time, and certainly not your priority time. So the first phase, I would say a year or so, is pretty chaotic assessment cycles going on as quickly as possible, and prioritizing the scenarios where you can actually save assets and create or resurrect value if you want. So this is about identifying the recovery strategies, developing individual business plans, doing technical due diligence, understanding the underlying assets, and so on and so forth. That leads into some sort of a proposal to a decision maker, which in our case is a committee of 5 people appointed by the client. And after the assessment, we run proposals, which then lead into a restructuring. So what to do? And in our case, this has involved a lot of corporate restructuring, going very closely to the buyer, to the borrower, assessing his operational capabilities, which in many cases, unfortunately, were appalling. The reason being that many property investors during the good years invested in property as a financial asset and disregarded the fact that this is really an operational asset, especially if you have multifamily housing or thousands of tenants. So this involves obviously capital restructuring, negotiations with senior lenders and junior lenders alike if they were involved, sometimes bondholders if they had issued corporate bonds as well. Legal restructuring, in many cases simplifying overly complex legal setups, tax setups that were thought to be efficient at the time of investment, but really ended up being extremely cumbersome and inefficient. And then lastly, surprisingly, as I said before, this involved a lot of operational restructuring, basically helping borrowers or taking over borrowers and rebuilding their operations, where cash had not been collected, contracts had not been managed, empty vacant space had not been relet. So basic property operations that had been ignored for a while, both because of the mindset of the investors being of the financial kind, but also simply because of the severe distress of the borrowers and operators. So bringing in interim management has been a big part of this, and then taking over the sort of corporate governance. And then, of course, that allows for a real asset restructuring, focusing on the underlying assets, initiating capex plans, investing into half-developed assets where you have huge value uplift opportunities. That's sort of the restructuring phase. Then out of that comes a stabilization phase. So either a restructuring ends up in a real estate being owned by our client, where assets have been taken over through voluntary or legal processes, or restructuring ends taking a non-performing loan, to a performing loan. So during a stabilization, we have either been holding keys to a property company that is sort of slowly improving their operations, or we've been holding a loan contract that is performing, but on most cases on new terms, where junior debt has been written to equity, where interest have been rolled up to allow for investments into the actual underlying assets, etc. So things might be performing, but certainly not on the original terms or on the original capitalization. And through stabilization and into a stable phase, we can sort of go towards exit or divestment. And as I will show you, obviously as time has passed, we've seen bulk of this particular case move from one side to the other. And now we are sort of moving quite heavily into a divestment phase, which involved obviously packaging and eventually transacting and selling then either a sub-portfolio of loans, which might be in a much better state than originally, maybe not fully performing on their original terms, but certainly performing on their current terms with a clear maturity profile and exit in mind. Or these are real estate companies that can simply be sold on a share purchase agreement in the market where they sit. So parallel to these sort of restructuring activities, there are operational activities. Basically, the role of operating credit administration, accounting, payment handling of both incoming interest payments and amortization payments, reporting and everything else involved in operating a credit department in a bank or a real estate investment fund. Because what this is, in the end, after restructuring and after taking ownership of assets, this is the two combined in one, really. So that's what the operational end needs to be tailored for. So it's neither a pure play real estate investor, investment management, nor a pure play bank, but a hybrid of the two. Now, just to sort of take a quantitative example of this particular case and how that has moved sort of through these cycles. I've actually in this diagram split the stabilization into stable and stabilization. So stable being this sort of when we come to closer to an exit. And sort of experience tells us that this is sort of the time frame of each of those steps. Assessment taking anywhere from 1 to 6 months, restructuring anywhere from 6 to 12 months. We've seen much longer, but we've also seen much shorter efforts here. We've seen efforts that have lasted more than 2.5 years due to various cross-border issues, due to too many insolvency processes being driven through courts and through decision-making problems with senior lenders that have collapsed themselves and been nationalized or semi-nationalized, etc. So certainly this is not a one-size-fits-all, but an indication rather. We've opted for a sort of 1 to 2 year stabilization phase. Obviously, when you go through restructuring, you could divest immediately, but you're normally then divesting a product that everybody will see as a distressed or asset or not as let's say stable as you could make the asset within a year or two. So normally there's quite an upside to be made by holding and stabilizing. A stable period is really to, if it's a company, to file at least one normal round of annual accounts to show a history of corporate governance, annual meetings and board meeting minutes that are normal and will sort of pass the test of due diligence of a buyer, and then an exit of 6 to 12 months period. So overall, this experience tells us that this process, and this could be typical for any loan book of this size and characteristics, is sort of 3 to 5 year period of time. Now, from what I sense through investors who are investing into loan portfolios today, they would rather like to see 3 or even shorter years, but they might be unrealistic in their expectation. I say might because it depends hugely on the circumstances and the market where the assets are. Now, on this particular book, you can see, and I'm going to go quickly through this, you can see a status point which happens to be in Q2 2010, where you can see sort of the bulk of the book is being either assessed or in restructuring and slowly moving into stabilization and being stable. Not much had been exited at the time, and you can see the status as it stands now, where this is much more shifted to the right-hand side of the picture, where the largest bulk of the book is either stable or already in an exit phase, or has already been closed, and only a small portion which is really in restructuring. And most of the things that we have in restructuring today are actually coming through another cycle of restructuring, where senior debt might have been negotiated on a 2-year term in 2009 or 10, and those 2 years have now passed, and we have to go back. If the asset is not ready for exit, we have to go back to the senior lender and negotiate further extensions, etc. So we've had one or sometimes 2 iterations of things being stable or cases being stable and coming then back into restructuring, and that is definitely to be expected. Just to summarize sort of the current status where we stand today, of the billion euro or so, it was 1,045 million to be exact at the outset. We have recovered in terms of funds about 440 million. That includes an 86 million cash flow of interest being serviced throughout the years. The expected remaining value is in the range of 400 to 450. So that gives us a total recovery range of 75 to 80% of this loan book. Compare that to the bids received in 2008 and early 9, which ranged from 15% to 50%, and the higher in that range required more vendor financing, so really not releasing much liquidity for the asset owner. The sort of expected best case when we started this process was a recovery of about 60%, so this is quite exceeding that. We are coming to the end of this particular mandate, so we can reflect a little bit on the experience as I'm trying to do here. We expect 85% of what's left to be completed before year-end 2014. We can pretty much drive that because a large portion of that comes through few large transactions, 3 large transactions of real estate owned deals where we are basically selling property companies and are not relying on borrowers refinancing their debt. So we control this timeline pretty well. Obviously, part of the final recoveries will come from performing loans that have maturity profiles in 14 and 15, and we believe are refinanceable at this state, but were certainly not in 2009 and 10. Just to draw some key learnings from this process. On one hand, in terms of operations, and on the other hand, in terms of workout strategy. And these are just some sort of sound bites that can be elaborated on in a much longer format than I can do here. First learning in terms of operations is, and I hope I'm not insulting anybody in this room, that banks, whether it's in terms of staff or infrastructure, are not normally well equipped for workout management and this type of work. They certainly need to be enhanced. I'm not saying they cannot be worked within a bank, but they certainly need to be enhanced, and team and reports and the data that is being managed within the bank is not normally adequate for this type of work. In terms of us taking on new mandates, it has proven to be key to retain the key staff, however, of the original lender, to keep some of that organizational memory, basically, keep some of the knowledge of how these loans were originated and what is the sort of insights of the borrower. Keep some of that, but certainly mix that up with new staff and certainly mix into banking staff with asset experience and transactional experience. We've been fortunate enough to recruit both property professionals and corporate finance professionals into the original core banking team, and this mix has proven quite successful. A hugely important thing is to incentivize and align the team with the task at hand. This is also where we see banks doing their internal workout having failed. The mindset of the staff needs to be to maximize value of assets and not to minimize losses of original loans. You might think this is the same thing and sort of can be seen as the same thing, but the mindset is quite different. Also very important to align the commitment time of staff to the expected workout timeline of the portfolio. You need to invest in infrastructure, for sure. We've invested heavily in our sort of data management, and the data that's being managed and the data that's being reported, it's hugely different from the times where we were managing a going concern bank and a going concern loan book. So this is a key thing. And a very important thing, and this we unfortunately have seen some of the senior lenders we are dealing with fail, which is to streamline decision making and give very clear mandates to the workout team in terms of what boundaries and what strategy they can work within, and then have decision-making capabilities in and delays counted in days and not counted in weeks, as we see, unfortunately, in many organizations. In terms of workout strategy, again, these are not our inventions, and this is probably sort of common sense and truth to many of those in this room that have been involved in similar activities. These are my own personal sort of takeaways. Number one, be proactive. Don't wait until the borrower comes to you. Be the first on site and be there before the other lenders get there, preferably. Very important to analyze your data, get the facts straight, and here you need to dig much deeper than a normal lender would do in his credit reviews. You need to go much more into the underlying asset and understand not just the sort of capital structure of those assets, but actually the operational challenges of those underlying assets and the opportunities if they are heavily distressed. Although we are sort of sitting within a law firm, which I appreciate, we have taken the path of absolutely exploring voluntary routes before going the legal routes. This has also been quite successful and means that we have actually, in most cases, been able to control the timelines involved. Those who have experienced might know, once you enter the courtroom, you're normally no longer in control of your timeline, and time can actually mean a wasted asset. And certainly a lost month of rent is lost forever. So it has been imperative to, as I said, combine this, be first on site, and try to work a voluntary solution and get control of the cash flow as soon as possible. Because otherwise it's lost, a lost month is lost forever. Important in terms of the mindset is to think like equity and not like debt, because even if you originally granted a loan, or the bank that operated granted a loan, chances are that either part or all of that loan is now really equity. So you better think like equity and behave like equity and not like a debt. In our case, because we started with a big bulk of junior debt, we had the pleasure of dealing with a lot of largest European senior lenders. And early on in 2009, we realized that they are really king in this situation. And we made a big effort in making friends with them and not enemies. And what we made them realize in many cases that we had to solve their situation in order to solve our clients' situations. And that has in many cases actually resulted in a quite successful relationship. We were fortunate enough to have some of the same senior lenders involved in several cases, so that meant that this was sort of a repetitive experience, and we could sort of build on the previous cases. And then a final point is very important in this kind of activity, is to know when to throw in the towel, not just in terms of when not to spend time, but to make sure that you never ever throw good money after the bad that is already lost. We've actually been in a situation to been able to support a lot of the cases we worked on by way of new lending, and in all cases that has been made on some type of super senior or preferred treatment. And in all cases where we've lent out new money on behalf of our clients, it has been to unlock situations where huge returns could be made on relatively small amounts of funds, like financing the completion of an empty asset that just needs the final step to be lettable, which is of course huge returns on a very short timeline. But then knowing when not to do that is the real crux of it.